Hello and welcome to Macro Mondays. I'm James Todd, Trader Performance Manager here at Onyx Commodities, standing in for James Brody this week. And today I'm joined by Spyros and Mita.
Hello everyone, I'm Spyros Kokas, oil research analyst here at Onyx Capital Group.
Hello, I'm Mita Chaturvedi. I'm a research associate here at Onyx Capital Group.
So today, like always, we'll be looking through key market data, charts and risks. Some of the headlines from the past week, we look at how President Trump is up to his usual tricks. He is looking to impose a 100% tariff on pharmaceutical imports, as well as a range of other tariffs. And we are now facing down both barrels of a potential US government shutdown going into the week ahead.
And following the shutdown, the risks of the shutdown, we see the US dollar continues weakening this morning, as well as the watch is on this week's key labor market data.
Due to this chaos with what's happening in the US and the dollar weakening, safe havens such as gold have risen to new heights this week. So we'll be talking a bit about that. The S&P 500, on the other hand, saw a weak end to last week, but recovered after a 3-day decline.
Cool. So to kick us off then, let's talk about Trump and the tariffs on pharmaceutical products. He's looking to impose tariffs of 100% on tariffs to all companies except for companies building their manufacturing in the US. And this supposedly is going to be taking place from the 1st of October. So we have until Wednesday now to impact all of these things. Is this sincere, or is this another taco Trump moment, do we think?
I mean, we know Trump, right? So far he's been, nothing has been set in stone. Any tariffs is imposed, or he did impose before, didn't materialize as quickly as he had said on his reports or on his Truth Social, but this is something very concerning, especially for countries like Japan, EU, and the UK, because they had reached an agreement of I think 15% of tariffs.
Yeah.
And it's really important. What do you think of that?
I think with the UK especially, so they were the first country to negotiate a trade deal, and that was such a success story for this government. But they never negotiated a tariff or deal with pharmaceuticals, and now that comes massively in the air with what happens with British pharmaceutical exports to the US. So there's a lot of uncertainty over there, but there is just so much uncertainty, so we don't really know how sincere this is, because the wording around it is so vague. For example, there's 100% tariffs to anyone other than companies who've built their manufacturing base in the US, and that means breaking ground in the US. So what does that mean exactly? And then what does it mean for USMCA products? Because I think there's a levy on trucks as well, and that massively impacts Mexico. But is that USMCA compliant? So there's so much with the fine print that's not really been discussed yet. So
yeah, I mean, in terms of the pattern of trade disruption that it's looking at, obviously, I think European, whether it be German, Irish or British pharmaceutical industries had been one of the sort of real supporters of growth over the past 30 years. And actually, even if you just turn your mind back to 2020, the COVID vaccine implementation, a lot of it was coming from UK or German-led companies. So these were areas that Europe and the UK, when I refer to Europe here, I'm probably talking about the geographical area Europe, so I'll include the UK in it. Europe had a real comparative advantage in. So it's not really too much of a surprise to my mind that Trump has now decided, we don't have an advantage in this area, therefore we must tariff to promote US growth. But I think in terms of actionable outcomes, it's going to be quite a mixed picture. And one of the things that's really worth noting as well is the impact that this will have on individual stocks. So the headlines here as well, AstraZeneca and GlaxoSmithKline, they fell around 1% on the Friday open. But these are huge companies, and ultimately, a 1% change in their stocks is probably not going to be the real impact. What you see with pharmaceuticals is typically these are very high risk equities to be involved in, because you have legislation and patents and also efficacy studies that suddenly make or break a stock. So they're already highly volatile. And if you were to shut down, another target audience for them, some of these smaller pharmaceutical companies that are producing experimental treatment drugs, et cetera, they are going to be very, very high risk equities right now due to these potential supply chain shocks. And then, let's talk about, there were other headlines coming in from the latest round of supposed tariffs and import levies. So the new levies of 50% on kitchen cabinets / vanities.
Yeah.
That's rather amusing. And then 30% on upholstered furniture and 25% on heavy trucks. So all of this stuff, yet again, we have another round of Trump, talking his own book and talking his own presidency. But what's the impact of this going to be? Are people going to be happy with this, or are they going to be, unhappy with potential increases in pharmaceutical prices?
Just on the macro level, just inflation, with that still being such a key thing that the Fed looks at, that people are going to be looking at, and that was a major part of Trump's agenda to reduce this year. All of this is just such it's just so diverging to that agenda. So I don't think people are going to be very happy about that, but it's yet to see how all of this really materializes.
Yeah.
Well, I think that's a great point, and that leads us on to the potential government shutdown, which, one of the leading issues with that is the spending bill and the potential, issues that the US government is going to face with regards to its debt. So, Spyros, what are your thoughts on the potential government shutdown?
Well, apparently the deadline is fastly approaching. It's on Wednesday, 1st of October, and it's mostly from the Democrat side, because they're asking about more healthcare funding and medical aid funding, which hasn't been so far, as it looks like, a top priority for Trump's government. And it's important to highlight again, as we did 2 weeks ago, that this is the third risk in the last 5 years.
Yeah.
And any potential shutdown could add 1 percentage point per week on GDP as a drag to GDP. And it's highly material in terms of data releases, CPI, and anything which we've seen recently. They've been highly unreliable.
Definitely. I think just most pressing, if there's a shutdown on Wednesday, what happens to the jobs data on Friday? Something as just near term as that. But I think just what you said, the bipartisan issue with the Democrats versus the Republicans, there's also just a little more pressure being put on the Democrats so that they're able to make those 7 votes needed in the Senate. So for example, the Office of Management and Budget has mentioned that agencies should consider a reduction of staff. They've asked agencies in the government to consider laying off staff if just financially it doesn't make sense to keep them, or if it's not consistent to keep them with the president's just priorities with the government. So I think with the Democrats, they would want to negotiate, let's say, bringing back Medicare, just healthcare benefits that are going to expire this year. But at the same time, they don't want to be responsible for the people that are going to be laid off if they don't.
I think that's a really important sort of point in the context of will they or will they not strike or shut down, because there are these looming cutbacks that are going to they've been rumored for a long time, and they are most likely going to be implemented by a regime that takes the wheat with the chaff and scythes everything down. But, they have said if people were not to turn up to work and were to shut down, they are the ones that they now have full authority to furlough them or remove their job. Mm-hmm. So people will be looking at this and think, oh crumbs, I'm in an industry that's looking to cut back. If I'm the one that sort of stays in the office, maybe I'm going to be positioning myself as an essential worker to my department. So I think you might see some interesting game theory in and amongst workers. If it reaches a critical mass and everyone does storm out, then it spells big problems. But people can be quite fickle when it comes to this sort of stuff.
Yeah. I think that's a good way to put it. It'll be a bit of a prisoner's dilemma until we see just no shutdown.
No, absolutely. Mm-hmm. And then, regarding jobs data, we have some data that came out for Q2. So we saw the revision on that. And it seems to be revision after revision after revision. And none of this actual jobs data seems to be reliable.
Jobs, GDP, we see GDP was revised hugely up. I think this is the fastest in the last 2 years, as we highlight. And I think the initial estimate was 3.1%. Now it's 3.8%. So these are big shifts that they do from the second estimate to the final revision, and it's again it poses the question whether we could really trust the initial revisions. You see the numbers constantly change, non-farm payrolls, GDP now, and the government shutdown risks accompanied by whether we're going to cut more jobs in US federal agencies is something really important we do need to keep an eye on.
No, you definitely need to keep an eye on it. And also, I mean, one of the interesting things to my mind is the volatility that you typically see after big announcements. So traditionally after non-farm payrolls, etc., there seems to be a lot of, whether it be people or algorithms trading off of the headline news.
Yeah.
Now, if you see in retrospect that headline after headline is not accurate, that becomes a problem. So you're trading on false information. The question becomes, how wrong is that information? And particularly with jobs, we've seen some of this information be completely wrong, giving a skewed picture to the extent where Trump says, I need to fire my head of stats, basically. I mean, that's an extreme example because he, of course, wants the data to be going in his favor.
Yeah.
But the point being, people were trading off, potentially bullish employment data, and it gets subsequently revised down. Trump's unhappy, but also if you've taken out a long position based on incorrect fundamentals, based on these headlines, your entire hypothesis could be incorrect if you're using that as your.
And that's what the market says right now. I think we see traders are headline fatigued. Any big data releases or any big announcements, even from Trump's side, do not materialize as they used to materialize in Q2, which is another big thing.
Yeah, definitely. So we have non-farm payrolls coming up for the end of September, don't we? So what are we expecting to see there?
I think expectations so far were that it's going to be around an increase of 39,000 for last month. But I mean, it is if that happens, it would be an increase to the month before that, but definitely a lot lower than data points that we'd seen before. So I think just overall, the market is still pricing somewhat pressurized settings with jobs datas. With PCE inflation coming up as expected, I think this would be the next thing everyone's going to look at vis-a-vis what the Fed's next decision would be.
Well, that's the really important thing because of course it looks as though they are perhaps looking at employment data even more than they are looking at inflation data at the moment. They seem to have this opinion that inflation data is more temporary. And so rather than making sort of myopic inflation decisions, they seem to be targeting employment data, which, yet again is difficult if you don't have good, reliable employment data. But yeah, it will be interesting to see what Powell and co do, particularly in the context. I think Trump made a truth on Truth Social, pointing a cartoon image of himself saying "You're fired" to Jerome Powell. So, I mean, the guy clearly gives no cares whatsoever about public perception on that. But
that's why we see the dollar weakening right now.
Yeah.
Uncertainty about the shutdown, then followed again, as you said, from the Powell tweet that said he's going to get fired. It feels like it's not this stable market the US like used to be, and no one is really willing to hold dollar, even if they hold US stocks. So we see a big appetite to hedge the dollar risk.
No, I completely agree, especially with the whole shutdown as well. You see two-year yields also declining. You see the dollar weakening, as this chart indicates. That there is just definitely distrust in the US right now.
Yeah, I think normally, especially government bonds are a great way of viewing that risk on, risk off appetite and, taking a perception on a country's economy. But yeah, the level of uncertainty and the flip-flopping that goes on in the US, I think makes the US dollar, really questionable. And so you see capital flight in and out based on headlines for sure. Yeah. But I think the trend is definitely down over the medium to long run here, which is quite interesting, especially considering, they had been slow to cut interest rates. And so if they had comparatively higher interest rates and you weren't seeing huge support on the dollar here, That's one thing, and I think that shows true sentiment. But as they slowly look as though they're going to be cutting, and that's only going to be detrimental for the US dollar as well.
I think more on that, just like I agree with that we definitely are looking to move downwards with the dollar, but just on a technical level, those two dotted lines that we see on this chart over here could provide near-term support. So just something to keep an eye on. That's just based on previous levels. So that could be interesting.
Yeah, and regarding dollar weakening, I think everybody's monitoring the dollar yen right now.
Yeah.
Yes.
The Bank of Japan, we've seen the very dovish. There is appetite to hike for one more time, at least for this year. And also the expectations of the new government that's going to be very less fiscally responsible compared to the previous government.
Yeah. I think just with the Bank of Japan as well, we recently saw Sai Noguchi, who has been a more dovish member of the Bank of Japan. He's long maintained to keep rates unchanged, has suddenly made a hawkish shift as well in line with inflation expectations. And I guess because of that, the market's also increasingly pricing in another potential hike at the end of October.
Yeah, I mean, it makes a difference, I suppose, in the interest rate differentials and the carry trade, but that mechanism, I think, has died a slow death over the past year or so. And yeah, I suppose you're just going to be seeing more and more convergence between the monetary policies of the two countries. At which point, the dollar yen, you do see trade flows influencing this. But I think managed money makes quite a difference in the dollar yen positioning as well. It's not purely imports from Japan to America and vice versa.
Yeah.
You have a lot of speculators who take significant views on these two developed economies' currencies.
No, definitely. More on that, positioning in the yen is split at the moment. So asset managers have lifted their yen longs. So it's up to 79,000, while leverage funds expanded their shorts to 63,000, just negative 63,000. So yeah, it just looks like positioning is also fairly split right now.
So asset managers are long and leverage funds are short. Okay.
Yes.
That's increasing. Yeah, so I suppose you'd expect to see volatility kind of increasing there. And on the previous chart, we did see that, you saw quite high peaks and quite low troughs. And of course, because the US dollar's strength, if we measure it as a basket against other currencies, the dollar yen is one of those constituent currencies, and the volatility that you see in the dollar is probably going to be really exacerbated here in the dollar yen divide. Cool. And then, moving on to safe havens. If you don't have money to put in the dollar and you're not sure about the dollar, what do you look at? Well, precious metals have been quite a good avenue over the past year or so, and we're seeing gold continuing to make all-time highs.
Yeah, definitely. I mean, as we signaled last week, I think it's all-time high week after an all-time high week. We haven't seen the gold stopping anywhere. See banks calling 4,500, 5,000, some of them. So I think there's still some potential upside move, and we see on the chart it's strongly ETF demand.
Definitely. Yeah, every time you think you've reached your cap, you just don't. It's just all new highs every week, as you said, Spiros. But that makes sense, especially with, to circle back with just all the uncertainty coming out of the US. It makes sense for people to look at precious metals such as gold and silver, which we'll go on to next.
Yeah, I think also just worth noting on that gold chart, one of the reasons why everything peaked and made an all-time high around sort of end of March, April, when it was Liberation Day, etc. You saw this all-time high being made, and then it didn't sort of carry on upwards. The reason for that, I don't think, was a lack of bullish sentiment in gold. You still had the fundamental uncertainty in a lot of other asset classes. You had central banks buying. So the bullish sentiment was still there. But the reason why I don't think it really, carried on all the way up was because of the necessities on, the constraints on liquidity of a lot of fund managers, etc. If they were long equities, if you cast your mind back to Liberation Day or Independence Day, equities were crashing. So their one position that they were long, if they were long gold, they had to liquidate that to support their equity losses. So as a result, you saw a lot of fluctuations and, things maintained for quite a while. But I ultimately see no issue with gold being this high. And I think the bullish factors that were prevalent in March and April are still there today. So I think it makes sense for it to be, around this level and perhaps even pushing on higher as more money comes into it.
Yeah, definitely.
But as you mentioned with the ETF buying, a lot of these ETFs seem to be baskets of precious metals. So you're not only seeing this love for gold, but you're seeing it in, palladium, in platinum, and also in silver.
Yeah, silver, this, at least today, it is another all-time high, obviously. And it's been the best performing metal this morning. And you see many, name it, traders, fund managers, they tend to look at the ratio between gold and silver. And we see that now this is the lowest since October last year.
The gold to silver ratio.
Yeah, the gold to silver ratio, exactly. And when you see a big change in this ratio, the people will try to capitalize on that. And yeah, we see right now the ratio is about 1 to 2 standard deviations below the average. So in my mind, I think we might have some silver strengthening even more right now. Do you think that?
No, definitely agree. It's interesting to me that gold to silver has fallen to its lowest. I agree. A lot of this has to do with ETFs. I think just getting this as a bundle. It'd be interesting to see just things like open interest as well, like whether people are looking to silver as a second safe haven, instead of as an alternative to gold.
Yeah, my impression is they very much are. And if you were to see, so gold is unquestionably at all-time highs now, whereas silver, you're basically at a 14-year high, I think it is. But back in 2011, there was this huge spike in silver prices, and then there was a huge sell-off as well as people, ultimately as variance and risk was higher. So from a trading an all-time high perspective, I think some people might be cautiously bullish gold if they're not believing in it. If they think that they have missed the gravy train on gold, they will probably look for the next one. And whilst silver is basically at this 14-year high, it's not quite at an all-time high. So maybe they're looking to silver for this reason. But yeah, it's an interesting one. I mean, I like precious metals, but I think I would probably take the attitude of going for a basket approach rather than just going in for silver per se. And ultimately that's driven by my idea that I do like gold here, and, the fundamentals of central bank buying and high risk in other assets, still makes gold attractive to me. So I wouldn't want to exclusively, be long silver here. But yeah, I mean, moving on to another asset class, we saw, quite an attempted comeback by the US team in the Ryder Cup last night. And similarly, we're seeing US equities make a bit of a comeback after a bit of a weak start, a weak middle period to the month. We're not quite on parity with where we should be. So yet again, another parallel with the Gulf. But what do we think of equities around here in the US? It's, it still seems to be supported at these levels, but are we going to be spiraling off here?
I'm not sure of how much it seems to be consolidating around this level, which isn't really a good look for further bullish sentiment, especially when you see, and coupling that with just the rallies that you see in precious metals just does not look that great with all the uncertainty in the US this week. I think people are also eyeing different news coming out of what the SEC is going to do with regulations and how stringent they're going to be. So I think right now I don't see US equities making all-time highs necessarily, but I do see them sort of finding a floor and maybe just sort of consolidating for a bit.
Yeah, that's an interesting point, but we see recently everything is retail driven, right? And we need to highlight here, I think in the US, the households hold the biggest share compared to other countries. It's approaching a third right now. So it feels like households will just keep buying, and everybody 401ks are maxed out on
US equities.
US equities, exactly. So I think if we see a slightly downward movement, but people might start buy the deep moment.
No, definitely.
Yeah, I mean, if it were to consolidate here, it would still be quite a high consolidation ultimately. Yeah, and it does seem to be very concentrated in this sort of Mag 7 and AI heavy tech group. But if we look to a stock that has had a very tough 12 months prior to this, if we talk about Boeing, Boeing's made a bit of a recovery here. What's going on there? What's the story?
So Turkish Airlines made a commitment to buy over 200 Boeing planes, which led to Boeing's share price to jump to $224, where it met resistance, but it ultimately still closed above 220, and I think there was like a 3.6% increase on Friday trading. So so definitely saw an increase because of it. Volume surged in the open to over 1 million, and they're roughly around 20,000 in normal times. So
volumes really pick up here. And ultimately when, if you have a belief that Boeing is still a valuable stock and it's just been, muddied by bad luck or dodgy headlines, then, you might see this order from Turkish Airlines as, there are still bullish fundamentals. What I would say is that you are still going to be very much at the whim of headlines going forward. And considering how much bad luck Boeing has had over a 12, 24-month period, or even slightly longer than that, it's you are running some headline risk with Boeing. And then, let's move on and talk about Brent. So we've seen a bit of a sell-off in Brent, but we feel like we're coming up on a bit of a consolidation. Is that the consensus here?
Yeah, I think we pretty much agree on that view. We saw last week we even approached pretty much 71 at some point. But the question is whether this is too much right now. I think we saw everything happening when Russian supply was being hit.
Yeah.
And that's a big question right now in the market. But yeah, it feels like be slightly more cautious right now. What do you think, Mita?
I think the market wants to be bullish, but I agree. The $70 handle is just such a barrier to get through. That used to be the case. I think it's become the new, like the what used to be the $80 earlier this year, or the $100 back like 2 years ago. So it's definitely a hard barrier to cross right now. I don't think we're gonna completely fall off a cliff. So if you look at this technical chart, Brent had been consolidating in this descending triangle formation for some time now, and it's recently broken out of it. So breaking out of a triangle usually means that now that you're out of a consolidation, you're going to have a volatility-driven rally or a volatility-driven sell-off. Basically, prices will go in one direction and for a bit. So right now we're seeing some correction after last week's rally, which broke out of the triangle. So my view is that we're still going to, just based off this, we're going to still see some floor around the $66 handle, and then we could see some consolidation or just see prices rise again.
So the upward line on the consolidation line might turn out to be a bit of a floor.
Yeah, I find this quite useful with futures, perhaps because a lot of algos might be looking at this as well. So, but I do think that downward trending line in that triangle could provide a floor in the near term.
Interesting. Yeah, I mean, trading breakouts is always quite difficult, and if you have to be quite convinced that the market has been trading these two converging lines as a breakout, but as a consolidation for it to be a viable breakout. If we look sort of slightly longer, it can just turn out to be a bit of noise. But no, it's an interesting point. And then, just talking about Brent a bit more, you referenced the Russian supply shocks that we had there, but we also have Indonesia and, potential exports to China being quite significant there.
Yeah, we used to see, I think until last month, we used to see Malaysia exporting a lot to China, and obviously this was Iran driven. Everybody was aware of that. But this now has slightly changed, while we see Indonesian exports around 600,000 barrels per day, which is a lot higher than their domestic output. We see at the same time Malaysian flows down almost a third in the last 2 months. So it's something everybody was looking at, I think, from Thursday onwards.
That's interesting,
Yeah, and Indonesia is usually a net importer. They don't produce a lot of crude. The demand is approximately 1.7 million barrels per day. So
that's fairly the same as Malaysia's previous pattern.
Yeah. So now seeing that they having record exports to China, it's something everybody was questioning. Obviously, you don't have the data to back it up because China always reports zero flows. But it's something everybody will keep an eye on.
Yeah, no, definitely. Cool. And then just to sort of wrap up the show, let's look at the OIS pricing for the next 12 months. So we see 98 bips of cuts forecast from the Fed. That seems to be consensus. And as we were referencing earlier, the BOJ at plus 53. So I suppose you're going to be seeing more and more convergence between US and Japan. But anything that stands out there for you? I mean, what are your thoughts on the ECB cuts? Looks very, very small there. Do we not think that the ECB is going to be cutting?
ECB looks like they're almost there. I think if they see inflation being 2% in the next couple of prints, we might see the markets start to increasing their bets for another maybe 25 interest rate cut. But so far they don't look like they want to cut anymore.
Yeah, I agree. I think with the Fed, what you highlighted earlier as well, that the Fed, it's such a risk mitigation point for them right now to cut, considering all the jobs data. So I think the ECB is sort of more inflation focused right now. But if the Fed keeps cutting, I think considering that they're sort of the standalone with the Western economies that we see over here, that could be interesting to see if this changes in the next few months.
Definitely. Cool. And then, just to end, let's look at some of the key data that's going to be released this week. So Monday, we have some Euro area economic sentiment and some Spanish inflation data. And then Tuesday, we get Japanese retail sales and Chinese manufacturing PMIs, German inflation. So there's going to be a lot of European inflation data coming out on Tuesday. And then Wednesday, we start to see some pretty significant data from the US.
Yeah, it's manufacturing data, following by from Tuesday's US jobs data.
Yep.
And Thursday as well, we have the job cuts and the usual jobless claims that we get.
Yeah, and Friday is going to be the non-farm payrolls, which everyone will be looking at. We're also going to have the ISM services PMI following the manufacturing data on Wednesday. That's hopefully that. This is all hoping that we don't have a government shutdown on Wednesday.
Yeah, I mean, assuming there is still a government to give some data from. Yeah, no, Friday, I think, is probably going to be the standout headline data that people will be trading from. You know, European inflation data will be interesting in the context of ECB cuts, but yeah, Friday will be the big one. But of course, if you want daily updates on everything macroeconomics, then look at Onyx Institute on LinkedIn, and we'll be providing daily summaries there. But yeah, in the meantime, thank you very much for listening and watching, and speak next Monday.